Welcome back to Sip and Talk.
Welcome, welcome. Happy to be here.
I have to tell you, I just got back from a Costco run. My cart was, loaded with enough paper towels and giant tubs of nuts to survive a small apocalypse.
The essentials?
The absolute essentials. But honestly, pushing that cart around these days, it really feels like a meditation on, shrinking purchasing power.
Oh, I feel that.
The 150 hot dog combo is still holding the line, bless its heart. But that pressure, everything soaring except wages, it feels really intense right now.
You are definitely not the only one feeling that.
Yeah.
And it's like a perfect snapshot of where we are economically.
Yeah.
Our listener mailbox is it's overflowing. And the main thing people are asking about is the very company you just visited. So many people are asking, hey, isn't Costco supposed to be the retail overachiever?
A safe bet.
The safe bet. Why is it that over the last 6 months, the market is climbing, but Costco's stock price looks like a broken escalator, just slowly heading down?
Yep.
We all thought it was the ultimate safe harbor, like the defensive stock you buy when the economy feels shaky.
Right.
And now it just feels like a bit of a drag on the portfolio. What is going on? Did even Warren Buffett have some kind of, prescience when he sold his stake all those years ago?
Well, that is precisely what we're getting into today on Sip and Talk. We're looking at two radically different corporate strategies that both led to these big market corrections in late 2025, early 2026.
Okay.
Costco's dip is, in a way, it's a correction fueled by its own history of performing too perfectly.
Too perfectly. How does that work?
Well, when you're priced for absolute flawless perfection, even minor headwinds, like, say, expected tariffs or just slightly slower growth, they cause serious turbulence because investors just scramble for the exits.
So that's one half of the story, the stable giant stumbling just because of high expectations.
Right. But here's the kicker. While retail world is obsessed with stability and protecting their margins, over in Silicon Valley, you have an 81-year-old titan making the highest stakes gamble of his life. And he's demanding every last penny of capital and just burning through cash at an astonishing rate.
You've got to be talking about Larry Ellison, the man who owns most of an island in Hawaii and was supposedly elbowing Elon Musk out of the way for computer chips.
That's the one. While Costco is meticulously guarding every penny of profit to protect that thin sacred gross margin, Oracle is dumping tens of billions of dollars, taking on huge debt and betting everything on an AI cloud future.
Wow. So these two companies are a perfect corporate contrast. One is, guarding the fortress anxiously?
And the other is going all in on the offensive.
That sounds incredibly dramatic. I mean, on one side, you've got my dependable rotisserie chicken and the certainty of the gas pump line.
And on the other, a mysterious, futuristic, and highly volatile AI cloud infrastructure bet. It's the ultimate yin and yang of corporate strategy.
So today we're going to explore why stable Costco, despite its perfect business model, is losing investor patience.
And why cash-burning Oracle, which saw its free cash flow plunge into the negative, is still viewed by many as a future money-printing machine, if the bet pays off.
We're going to give both strategies a full, comprehensive discussion, starting right now.
This is going to be good.
Grab your coffee, Sip and Talkers. Let's get started.
Okay, so let's unpack this with a deeper look at the captains steering these ships. Because the difference in their strategies, it's fundamentally rooted in their personal philosophies, their backgrounds.
This really is the collision of the tech offensive empire and the stable retail bedrock.
It really is. On one side, you've got the visionary autocrat, Larry Ellison. I mean, this man is labeled the Silicon Valley legend, sometimes even the last samurai.
A throwback to the founders who, ruled their companies like personal kingdoms.
Exactly. His style is overtly autocratic and visionary. He maintains absolute centralized control, even in his early 80s.
And that control isn't just on paper, right? It's legendary within the tech world.
Oh, yeah. He has this obsession with minute technical details. You hear stories about how, while CEOs at Amazon or Microsoft might delegate strategy, Ellison is reportedly still personally inserting himself into discussions about low-level product architecture or database design.
Things most CEOs wouldn't touch.
Things they wouldn't even understand. This is totally foreign to a modern, consensus-driven corporate culture where the CEO is often just, a cheerleader and a high-level strategist.
And his core drive is just winning.
Winning at all costs.
Yeah.
He views business as a personal competition, just like his high-stakes America's Cup sailboat races. For him, being second place is just being the first loser.
That philosophy that he has to be ahead, he has to dominate, that leads to a naturally aggressive, centralized approach. It lets Oracle pivot incredibly fast, like we saw with this sudden massive AI shift. Yeah. Speed over consensus.
Now contrast that entire worldview with Ron Vakris, the cultural guardian at Costco.
Such a different title.
Vakris is the ultimate internal promotion success story. I mean, this is a man who started working at Costco over 40 years ago as a forklift operator.
A forklift operator. Just think about that journey for a second. From the warehouse floor, physically moving boxes, to the CEO suite. That background has to define his entire approach.
It does. That humility, it manifests in what you'd call classic servant leadership. His focus is entirely on optimizing the fundamentals: employee welfare, supply chain stability, maximizing warehouse efficiency.
He is not the bold visionary promising to change the world.
No, he's the careful steward, ensuring the integrity and the present success of a wildly popular, but, let's be honest, a physically demanding operation.
He's been really clear about his mission since he took the top job, right?
Very clear. He said his main task is not to mess up the culture. He often emphasizes that culture, the commitment to employees and that customer promise, is the only competitive advantage Costco truly has against the sheer technological might and convenience of giants like Amazon.
And it isn't just talk. He actually backs that up with money.
Big money. We've seen him rigorously hold the line on that razor-thin 14% to 15% gross margin discipline, while at the same time ensuring employee conditions are among the best in retail.
We're talking about the minimum wage being pushed up to $30 an hour in some places, right?
Yeah, plus generous benefits, high contribution retirement plans. This stabilization strategy is highly expensive, but Vakris clearly views it as a necessary cultural investment.
It's just a remarkable cultural chasm between the two. Let's dig into the foundational philosophies, the DNA test, so to speak. Oracle's DNA is just pure winner takes all.
Absolutely. It's built on technological supremacy and just raw competition. Oracle was founded in 1977, and the whole concept was starked because they read an IBM paper on relational databases, a technology IBM themselves initially overlooked.
So Oracle jumped on it.
They jumped on it. Their first major client was the CIA, under the project codename, Oracle. The company's identity is literally wrapped up in seizing opportunities others missed and then winning the database war against the legacy players.
And their philosophy, which Ellison has reinforced for decades, is notoriously competitive, almost militaristic.
There's that famous quote, often attributed to Genghis Khan, that it's not enough for them to succeed, others must fail. That spirit it permeates Oracle.
It definitely fosters a talent density over consensus culture, prioritizing the brightest technical minds who can execute quickly.
For sure. But we have to acknowledge that over the decades, it also earned them a reputation for aggressive, sometimes even hostile sales tactics that maximize revenue, maybe not always customer satisfaction.
Right. And Costco, on the other hand, is built on the complete opposite structure. They call it the inverted pyramid internally.
That's right. It was founded in 1983, and it was largely based on this highly disciplined, kind of counterintuitive retail model pioneered by Sol Price's Price Club.
And the core philosophy is just beautifully simple. And patient.
So patient. The idea, driven by co-founder Jim Sinegal and now rigorously continued by Vakris, is that if employees are paid well, have good benefits, and customers are happy with consistently low prices,
which are guaranteed by that 14% margin cap.
Exactly. Then the shareholders will follow as a natural long-term consequence. It's a model built on deferred gratification. You put the consumer and the employee first.
The financial discipline around that 14% to 15% gross margin limit is what really defines them.
It's insane. Most major retailers aim for margins closer to 20%, maybe even 30%. Costco's willingness to operate on such thin ice is the very thing that builds their unbreakable brand moat.
Customers just know they can't be undercut elsewhere. It reinforces this fierce, almost generational loyalty.
So if we try to just summarize this whole contrast, here's my cold take. Ellison is the madman who will convert his entire luxury yacht into a stealth fighter jet just to win the current tech race against his rivals.
He's obsessed with disruption, with speed, with status.
Exactly. And Vakris, he's the captain who is down in the ship's hold, checking every single rivet for rust, ensuring employee safety, and personally making sure every sailor has lunch meat and a stable schedule for the journey.
He's obsessed with operational excellence and cultural preservation.
The contrast between the tech empire betting $300 billion on the future and the retail bedrock defending a $1.50 hot dog in the present. It just couldn't be clearer.
Okay, so let's pivot entirely now and look at the specifics of this. This monumental bet Larry Ellison is making. It's known internally as the Stardate Project, and the scope is just dizzying. Not just in dollars, but in physical complexity.
This is absolutely not just a routine commercial deal. This is an infrastructure commitment that rivals, like, national development projects.
And the origin story is pure Silicon Valley drama, right? I heard it kicked off with a private message on LinkedIn.
That's the story. A LinkedIn DM between these two corporate giants. OpenAI was suffering what insiders called a severe compute drought.
A compute drought?
Yeah, they were the hottest, most rapidly expanding application in the world, and they were metaphorically running out of gas. They were running out of the raw compute power needed to train the next generation of large language models. They needed servers, like yesterday.
And they needed them designed for hyperscale AI workloads, which is a very specific thing.
A very specific thing. And this is where Oracle's historical position and Ellison's competitive nature paid off. Oracle Cloud Infrastructure, or OCI, had already designed proprietary specialized infrastructure, optimized for this kind of massive parallel processing.
Wasn't that originally for Elon Musk's xAI venture?
That's what's been reported. And that preparedness allowed them to immediately strike this massive deal with OpenAI, reportedly valued up to $300 billion over the next decade.
$300 billion, that's just a staggering number.
It is. And this is designed to give Oracle the massive, immediate foothold they desperately need in the AI cloud infrastructure market against Amazon Web Services and Microsoft Azure.
But this partnership, it brings some pretty extreme physical realities into sharp relief.
Oh, yeah. The commitment involves building 5 gigantic, highly specialized data centers for OpenAI. The scale is almost incomprehensible. We're talking about a total power consumption that will eventually hit 4.5 gigawatts.
Okay, you have to put that number into context for us. 4.5 gigawatts means nothing to me.
Okay, 4.5 gigawatts is larger than the entire household power consumption of a metropolitan area the size of Chicago.
Wow, so this isn't powering a neighborhood, it's powering what is essentially the brain of the next economic revolution.
Exactly. And to deploy that kind of power load requires immense planning and immediate execution. Which brings us to the profound irony that critics are rightly pointing out.
Which is?
In order to meet the immediate deadlines demanded by this compute drought, Oracle is reportedly relying heavily on massive natural gas generators to power these centers.
So fossil fuels.
Especially for the ones located in the sprawling Texas wilderness where grid stability is a known issue. The visual of burning massive amounts of fossil fuels to power the most intelligent AI, the supposed engine of a clean, efficient future, it's loaded with contradictions.
Moving from the physical extremes to the financial stress, this high-stakes bet, it naturally led to extreme stock volatility for Oracle, a classic boom and bust cycle.
Absolutely. The stock initially soared to historical highs in the third quarter of 2025. Ellison was riding high on the AI wave. He was making aggressive projections, talking about 14x cloud revenue growth by 2031.
Announcing deals with Meta and NVIDIA, investors were buying the dream.
They were. Then, the painful reality of the investment hit. The stock plunged around 40% in the fourth quarter of 2025. And the core reason was intense cashing out anxiety, driven by the sudden massive capital expenditure, or CapEx.
Right.
Oracle, a mature, profitable, cash-generating company, saw its free cash flow, its FCF, turn negative for the first time since 1992.
1992, that is a staggering reversal for a business of its age.
And the scale of the CapEx is why. It jumped to an astronomical $50 billion for the 2026 fiscal year, way up from the expected $20 billion they'd guided for.
And that cash was just needed immediately to buy GPUs from NVIDIA and build these data centers to meet the OpenAI timeline. It was a massive corporate Hail Mary.
And this huge investment requires massive financing. Oracle's total debt burden climbed to well over $100 billion.
$100 billion.
And the market anxiety was severely triggered in December 2025 when news broke that a major financier, Blue Owl Capital, pulled out of a significant data center financing deal.
Why did they do that?
Their concern was explicit. The combination of Oracle's high debt coupled with the long-term, potentially harsh lease terms. It just made the project too risky to fund easily in a high-interest rate environment. It was a massive vote of non-confidence from the lending world.
This financing pressure, it leads us right to the current cyclical spending pattern, what analysts are calling the AI bubble dynamic, the left-hand, right-hand problem.
Right, and this dynamic is all about the quality of the revenue being generated. It is a remarkable circular flow of money within the tech oligarchy.
Okay, break it down.
Oracle buys NVIDIA chips, which generates revenue for NVIDIA. Then NVIDIA turns around and rents specialized Oracle servers for their own research.
Okay.
And OpenAI, which is heavily subsidized by Microsoft, uses Microsoft's money to pay Oracle for these huge data centers.
So it's like three friends loaning each other the same $100 bill to pay off a single shared debt.
That's a great analogy. The money moves, the books look balanced, but no net new wealth has been created yet. This cycle makes Oracle's contracted revenue, the remaining performance obligation, or RPO, look huge. It's sitting at over $99 billion.
But it raises the critical question that's making investors nervous. Is the end consumer ultimately going to pay for all this? Or is this just the same few tech behemoths cycling money back and forth in a closed loop?
That's the big fear. And the core risk is single client dependency. Analysts are deeply concerned that a significant portion of that $300 billion contract relies entirely on OpenAI.
And OpenAI, even with Microsoft's backing and its huge valuation, is still operating at a heavy loss.
Exactly. So if OpenAI's growth falters, or if the underlying technology pivots quickly toward more efficient, smaller models that don't need these 4.5 gigawatt data centers,
Oracle's massive, specialized, expensive infrastructure could instantly become scrap metal. Just instantaneous overcapacity and obsolescence.
Which brings us back full circle to Ellison psychology. Why the desperate, immediate push? It's not merely a business decision, it's deeply personal. It's the profound fear of missing the age.
He famously, and very short-sightedly, mocked cloud computing as nonsense back in 2008.
He said it was just watered-down SaaS. That one decision arguably cost Oracle an entire decade, letting rivals like Amazon Web Services and Microsoft Azure establish an unassailable lead in the market.
And now he's acting on that massive historical loss.
Yes. If we apply classic behavioral economics, specifically prospect theory, Ellison is operating from the loss of main. When a person or a company is dealing with a prior significant failure, they typically shift from being risk-averse to exhibiting extreme risk pursuit to compensate.
So he isn't just making an investment, he's conducting psychological compensation. He's using $300 billion to try and reclaim that lost decade.
He's betting his legacy on becoming the foundational godfather figure in the AI era, even in his final years. He doesn't want to be remembered as the guy who missed the cloud. He wants to be the guy who powered the AI revolution.
All right, let's shift gears entirely and look at the market correction at the other end of the corporate spectrum, Costco. The perception among loyal members is that nothing is wrong with the company. The stores are packed, the hot dog is cheap.
But the stock keeps falling. That's exactly the paradox. Costco was down, 5 to 8% over the last half year, which is a major unacceptable underperformance when the S&P 500 was posting strong, sustained gains.
So this isn't a problem with the company itself, it's a problem with the price.
The core logic here is simple. The stock was priced too perfectly, which necessitated a massive valuation correction. The price-to-earnings ratio for Costco, the PE ratio, had soared above 50x.
And let's be clear what that means. A typical, highly efficient retailer like a Walmart or a Target might trade in the 18x to 25x PE range.
Exactly. So paying 50 times earnings for a retailer that sells bulk paper towels and rotisserie chicken is considered an extreme, unjustified premium. Investors were essentially pricing in 5 to 10 years of flawless future growth.
Which meant that any slight deviation from those aggressive, heroic projections would trigger a massive sell-off.
And the catalyst was a slight but disappointing growth slowdown. U.S. same-store sales growth, or comps, slowed from above 10%, which they hit during the peak post-pandemic spending, down to the 5.8 to 6.4% range in late 2025.
Now, if you look at that 6% sales growth in isolation, it's absolutely stellar for a mature retailer. Most would kill for that number.
For sure. But when you have a 50x PE ratio, 6% is profoundly disappointing because the market was demanding 10% plus. So investors who bought at the peak just decided to immediately take profits and shift capital to places with less future expectation baked into the price.
But beneath all that stock volatility lies the actual unbreakable financial bedrock, the membership fortress. This is where Costco's real strength is, right?
It is. This is the key difference between them and almost every other physical retailer. We saw the largest test of this fortress in 2024 when Ron Vakris, adhering to the company's internal clock, finally raised North American membership fees by $5 to $10.
The first time since 2017, and it was a huge, risky test of customer loyalty during a high inflation environment.
And they passed with flying colors. The global renewal rate remains incredibly strong, stubbornly above 90%.
And it's crucial to understand the financial mechanics of that fee hike. That money translates almost directly into pure net profit.
That's the key, because the fees cover the majority of the operational overhead warehousing, supply chain, and crucially, employee benefits. So those millions of dollars generated annually from the membership fee flow right to the bottom line,
Acting as risk insurance and covering the basic costs of doing business.
which allows them to continue their incredible self-sustaining defensive strategy of offering items at a negative gross margin, like that famously resilient rotisserie chicken and the 150 hot dog combo.
It's the genius of the model. They lose a little money on the chicken and the hot dog, but these items attract incredible foot traffic. Once you're inside, you load up on higher margin items like electronics, clothing, gasoline, optical goods.
All of which are priced well, but still offer a better margin than the food court loss leaders. In fact, their low price promise makes them extremely resilient during economic slowdowns. When inflation bites, as you felt, people look for value. Costco becomes even more attractive.
Keeping that high renewal rate intact, it's a protective moat built out of cheap food and bulk necessities.
However, even this fortress isn't immune to external pressure tests. Specifically, the aggressive 2025 tariff policies targeting imports from key manufacturing partners like China and Mexico.
This is a direct hit, a profit meat grinder for a low-margin business.
It really is. Costco faces high sensitivity to rising costs, specifically because 25 to 30% of its total merchandise relies on imports from those taxed nations. Tariffs immediately increase the cost of goods, sold to KGS at the dock.
And this puts Ron Vakris in an impossible squeeze, really testing his cultural commitment. He has two painful choices.
Right. Either he violates the core low-price promise and passes the tariff cost onto the consumer, which erodes the brand moat.
Or he sacrifices the already thin 14 to 15% margin discipline, which crushes short-term profits and disappoints those PE-fixated investors.
And reports indicate that Costco is rapidly trying to mitigate this by accelerating supply chain relocation to Southeast Asia and increasing domestic sourcing, trying to find alternatives. But relocating complex global supply chains takes a lot of time and a lot of capital.
So the tariff pressure will likely persist and squeeze their margins for the short term, fueling this current valuation correction.
And finally, we have to revisit the decision that shocked everyone 5 years ago, the Buffett perspective. Why did he sell his 20-year Costco stake back in 2020?
It's crucial to clarify this wasn't a critique of the company itself, was it? Charlie Munger, Buffett's late partner, was a passionate champion of Costco.
He was a director there for years. He famously called it one of the few companies Amazon could never truly beat. No, the sale was purely a financial discipline move. It was recognizing the critical difference between price over value.
Buffett loved the business, but he felt the stock's PE was just too high. The market had already priced in too many years of future perfection.
And when the price is that high, his fundamental principle, the margin of safety, vanishes. Buffett simply recognized the opportunity cost and shifted capital somewhere else.
It just confirms the central thesis of the correction. Even a perfect company can be an imperfect investment if the valuation gets entirely out of whack with economic reality.
Okay, let's bring these two parallel universes back together. The most striking thing is the shared headwinds, the unlikely common ground that caused both the AI titan and the retail bedrock to stumble at the same time in late 2025.
Despite being in radically different industries, they suffered from the exact same expectation management failure.
Exactly. Both experienced these prolonged stock surges built on hype. Oracle on the AI future, Costco on retail infallibility. Any slight slowdown in sales or any unexpected cost overrun, no matter how small, triggered immediate profit-taking.
Capital just looked for safer ground.
Instantly. And they both faced high capital pressure, driven by the sustained high interest rate environment. For Oracle, the high cost of money made their massive $50 billion capex extremely expensive to finance, on top of their existing $100 billion debt load. They're paying a premium for that AI sprint.
And for Costco, the high-rate environment pressured their margin expansion goals. It squeezed them on logistical costs, facility construction, all while fighting off the tariff pressure.
Both were victimized by capital markets demanding more for less risk. We also saw a clear market-style shift in late 2025. Capital began flowing away from these growth and valuation star stocks and toward more defensive, less volatile, value-oriented companies.
A classic rotation, triggering a deep technical adjustment in both Oracle and Costco as funds sought better risk-adjusted returns elsewhere.
So what does 2026 look like for these two fundamentally different strategies? Let's start with Oracle, the explosive vision.
The Oracle forecast is undeniably high risk, high reward.
Completely. The entire fate of the company hinges on one number. That $99 billion RPO remaining performance obligation. That's the value of their contracted but unearned revenue.
The key variable is whether Oracle can successfully prove that this massive RPO is converting to real, profitable cloud revenue streams quickly enough to justify the CapEx burn.
Exactly. Analysts will be watching OCI's gross margins and client retention rates like hawks. If conversion is proven and sustainable, analysts are predicting a massive rebound potential, potentially over 50%.
That would cement them as the third pillar of the cloud market.
They're the most ambitious and certainly the most senior challenger in the AI infrastructure war. Their future is entirely tied to the speed of that conversion and whether the AI boom sustains its unprecedented momentum.
And if the conversion fails, they are left with gigantic, specialized, half-empty data centers and a crushing debt load.
Now, Costco, on the other hand, is the chronic return to mean. The forecast suggests 2026 will be a restructuring year, a period of digesting the overvaluation and mitigating those external pressures.
Management will focus on operational efficiency and managing the tariff squeeze.
But the long-term strength remains absolutely solid. That's due to the pure profit stability derived from the membership fee hike, which is now fully baked into their annual revenue, plus aggressive overseas expansion, particularly in high-growth markets in Asia and Europe.
Short-term challenge, surviving the margin squeeze and the stock digesting its own perfection.
In short, Oracle needs to prove it can earn the money it borrowed and spent. And Costco needs to prove it can grow fast enough to justify a premium that is still historically high for a retailer, even after this correction.
Which brings us to the final philosophical debate, the core conflict between these two transformation logics. Oracle represents the radical future.
Borrowing heavily, expanding aggressively, embracing volatility, and betting everything on the high-tech AI conversion rate succeeding.
And Costco represents conservative stability. Raising fees incrementally, relying on fierce defensive customer loyalty, and betting on the long-term non-negotiable necessity of essential goods. They're betting on the stability of human habit.
The life analogy sums it up perfectly for you, the listener. Buying Oracle stock it's like chasing a talented, volatile rock star who's currently in massive debt and has alienated many former partners.
But who could release the album of the century tomorrow and change the industry forever?
Exactly. And buying Costco is like dating a reliable, good person who's currently stressed out about rising living costs and dealing with the political reality of external tariffs.
But whose commitment to you and whose core values, providing value and taking care of their people, are unwavering.
So the question for you, our listener, is which transformation logic do you back in 2026? Ellison's high-stakes AI gamble built on debt and speed, or Vacris's measured defensive cultural defense built on consistency and loyalty?
This comparison really shows that the market is currently correcting optimism across the board, regardless of the industry. Investors are demanding proof of concept, realistic valuations, and a clear path toward profitability, even from the giants.
And we want to emphasize, as always, that this was an objective analysis of data points and corporate strategies drawn from market reports and industry observation. We are not investment experts, and this is not financial advice, just a factual deep dive.
Our goal is simply to provide context to help you understand the forces driving the market corrections you're seeing right now.
We encourage continued scrutiny of market forces and always urge you to think independently about what corporate strategy truly drives long-term value.
And before we go, make sure you subscribe to the Sip and Talk podcast wherever you listen so you don't miss our next deep dive.
And also check out our friend Micky's YouTube channel, Micky to Life, for fun memes and the latest travel vlogs.
We'll see you next time.